All right, okay. Hi, everyone. Right, welcome to today's webinar brought to you by Vantage. Right, where today we're going to take a look at how US inflation has evolved since the beginning of the year. Right, okay, so before we begin, just want to let you all know we're streaming directly into the Vantage app as well as over Zoom. So do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. Right, before we begin, please take note of the disclaimer. And information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin funds and CFDs as they carry significant risks and is not suitable for all investors. Right, my name is Ketan Ramachandra, and this webinar series is brought to you to special partnership between Vantage and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so here's the agenda for today, right? So we'll take a look at how consumer inflation has progressed in 2025, right? Generally speaking, in the first quarter of this year, right, consumer inflation was relatively sticky, right? And we'll see how it has evolved since then. We'll also take a look at how the trade war has increased price pressures in the US as well, to take a look at whether the impending tariffs has had any bump up in prices for at the consumer level and at the producer level. And finally, we'll wrap things up by taking a look at how we can expect inflationary pressures to evolve in the second half of this year, right? Will we see inflationary pressures continuing to dissipate further? Right. So basically, in the first quarter of 2025, right, which is from January to February, inflation was relatively sticky, right, particularly consumer inflation, with both headline and core CPI remaining well above the Fed's target of 2%. Right. So headline, so for example, we're looking at first quarter data, right? Headline CPI was averaging around 2.6% year over year in February and March, but was showing signs of cooling from earlier highs. Remember, in January, CPI had hit 3%. Headline CPI had hit 3%. So while consumer inflation, headline CPI was still elevated, it was starting to move in the right direction. Core CPI, which excludes volatile food and energy prices, was also elevated at 3.1% year over year in February, reflecting persistent underlying price pressures, particularly in services like shelter. Now, since Q1, inflation has continued to moderate, though the trajectory has been uneven due to trade tariffs and policy uncertainties. Now, let's take a look at how consumer inflation has evolved since March, right? In March, headline CPI cooled unexpectedly to 2.4% year over year, with the monthly decline of 0.1%, which was the first decline since May of 2020. Core CPI eased to 2.8% as well, the lowest level since March of 2021, driven by falling energy prices, particularly gasoline, which was down 6.3%. And also there was some relief in grocery prices, despite egg prices spiking higher due to the avian flu. Now moving over to April, headline CPI eased further, declining to 2.3% year over year, the lowest level since Feb 2021, while the monthly increase saw gains of 0.2%. Core CPI continued to remain unchanged at 2.8% as lower prices for gasoline, groceries, apparel, and used cars contributed, but shelter costs continued to exert upward pressure. Now, at this point in time, right, this was April, tariff impacts were minimal as businesses absorb the additional cost or use pre-tariff inventories. In May, right, headline CPI accelerated slightly, right, after moderating to 2.3% in March. In April, headline CPI accelerated slightly to 2.4% year over year in May, with a modest monthly gain of 0.1%. However, this was well below the expectations of 0.2%. Core CPI continued to remain unchanged at 2.8%, and we saw continued decline in energy prices, gasoline down 2.6%, as well as continued cheaper prices for vehicle and apparels as well, which offset rises in shelter and food costs. So shelter and food costs continue to remain elevated. Now, in May, tariff-related price pressures were still muted, likely due to inventory drawdowns and cautious price adjustments by businesses, as well as the 90-day pause on tariffs that was in effect as well. Now, overall, inflation has trended downwards since the first quarter of this year, approaching the Fed's 2% target, with core CPI stabilizing at 2.8% year over year. Services disinflation, particularly in housing and weak energy prices, have been key drivers in recent months, right? Though goods prices have shown early signs of tariff-related increases. So this will take a slightly closer look in the following slides. Now, on a monthly basis, right, we can see in the last quarter of 2024, headline CPI was rising strongly, right, on a monthly basis before easing in February and even posting a deflationary reading in March. Core CPI as well was rising strongly on a monthly basis in the second half of 2024 before slightly easing off from February onwards. Looking at the annualized reading, right, we can see headline CPI clearly accelerating in the last quarter of 2024, rising from an annualized rate of 2.4% in September to as high as 3% in January of this year. Since February, we've seen inflationary pressures start to moderate lower, right? We've seen headline CPI ease as low as 2.3% back in April. However, May's figures, which came out last week, saw a slight uptick in inflationary pressures. Core CPI, on the other hand, continued to remain elevated at around 3.2 to 3.3% for most parts of 2024. However, we finally started to see price pressures for the core reading start to moderate significantly lower, dropping down to an annualized rate of 2.8% in March, and this reading has remained unchanged all the way through May. PPI, right? PPI, which is Producer Price Index, measures the level of inflation in the wholesale sector. These readings also showed inflationary pressures accelerating for both headline and core PPI. And we can see headline PPI accelerating from about 2.1% in September of last year to as high as 3.8% in January. After that, we've seen headline PPI moderate significantly lower, dropping down as low as 2.4% back in April before edging slightly higher. Core PPI as well accelerated in the second half of 2024, rising from like 2.6% annualized rate of 2.6% in July to as high as 3.9% in January of this year. Now, since April, we've seen core PPI start to moderate noticeably lower as well. Right, so for now, right, based on the second quarter's readings, right, for both headline and core CPI and PPI, we're starting to see some disinflationary pressures start to gain traction, but we're not out of the woods just yet. Right, so now we'll take a look. We'll touch on and see whether the trade war and tariffs that were imposed have increased price pressures in the US. Remember, although there's a 90-day pause for most tariffs on commodities such as steel and aluminum continue to remain in place. Now, let's see what has happened, right? Let's do a quick review of the tariff situation. Right, so US President Donald Trump's trade tariffs initiated in early 2025. Remember, in as early as February and March, President Trump had already issued tariffs on steel and aluminium, right? 25% tariffs on steel and aluminium, followed by further announcements on Liberation Day, which was on 2nd of April, where we saw a 10% universal duty on US imports, the continued 25% tariffs on steel and aluminium imports as well, and of course, varying levies on Chinese goods, though many were paused or rolled back due to the 90-day pause as well. Now, these policies, combined with uncertainties around their scope and duration, have influenced inflation dynamics, but have not yet caused a significant price shock to consumers just yet. So there have been limited impact by the tariffs so far, right through May 2025. Tariff effects on CPI have been modest, as businesses have absorbed costs for now, and they've done this because they've continued to use, or they've managed to use pre-tariff inventories, or are also facing weak consumer demand, thus delaying the price pass-through. For example, when vehicle and apparel prices declined in May, despite expectations of tariff-driven increases, while regional Fed services indicate over half of affected businesses plan to raise price within 3 months, suggesting delayed impacts. So perhaps we could see right, some price pressures pick up noticeably in the third quarter of this year. Now, we are some the price pressure so far has been pretty nascent, right? Some tariff-related price increases emerged in April, with audio equipment jumping 9% and photographic equipment up 2.2% on a monthly basis. Now, many analysts expect goods inflation to rise gradually as inventories deplete and businesses pass costs to consumers, particularly in the summer of this year. Remember, a lot of businesses are continuing to sell pre-tariff inventories, but that could all change as these inventory levels get depleted. Now, looking at policy uncertainty effects, right? There's certainly a lot of continued uncertainty surrounding tariff policies, immigration restrictions, and fiscal measures, right? This has weighed heavily on consumer and business sentiment, contributing to market volatility and a weaker US dollar since January, right? Not only consumers, households, and businesses, right? They have all had their outlook impacted negatively, and with uncertainty remaining elevated, right? Many are holding back on making big ticket purchases. Now, this could be at a consumer level, household level, or businesses. All these entities, right? All these players are generally holding back on big ticket purchases for now, which is also explains why the price pressures have not been so noticeable as well. Now, the uncertainty has also led to some businesses front-loading a lot of imports before the tariffs take place. This has exacerbated trade deficits and is potentially adding to inflationary pressures as well. Now, longer-term inflation expectations surged to 4.1% in March of this year, the highest since 1933, reflecting tariff concerns. But since then, we've seen the latest long-term inflation expectations moderate down to about an annualized rate of 3.6%, as seen in the latest preliminary findings by the University of Michigan on its consumer sentiment survey. Now, economic risks, right? No doubt the tariffs place or have increased economic risk as well, not only for the US, but at a global level, right? The tariffs are expected to raise inflation while slowing growth, with many economists warning of stagflation risk as well. The latest Fed's meeting, FOMC meeting, minutes that took place in May of 2025 noted tariffs could push inflation to 4% by the end of this year, right, by the fourth quarter of this year, with effects lingering into 2026 if those tariffs eventually get reinstated and are sustained for the remainder of the year. Now, Goldman Sachs has also raised its 12-month recession probability to as high as 20% back in March, citing tariff-driven headwinds. Now, all of this has led to uncertainty on the outlook for policy, right? On the outlook for various policy actions, right? So, oh, sorry. All right. Okay. So we've already covered this as well, right? So policy effects have already been covered. Yeah. Now, looking at uh, the prices indices for the ISM report, right? The ISM is the Institute for Supply Management, and it released two PMI reports for the manufacturing, one for the manufacturing sector and one for the services sector. In the recent report, which was for the month of April, right? The recent report is for the month of April. We saw ISM prices registered a reading of 69.4%, where we saw 16 out of the 18 industries reporting paying higher prices for raw materials, right? You can see here very clearly prices for raw materials in the second quarter of this year, or rather in the first quarter of this year, have accelerated quite sharply. Similarly, services prices for services have also accelerated with the latest reading in April, rising to 68.7%, where we also saw 16 of the 18 services companies or industries reporting increases in prices paid. So we can see right at the producer level, whether it's from the manufacturing or services sector, cost price pressures for goods, whether it's raw materials or the services itself, have started to increase noticeably. And typically, when we see an increase in PMI prices, right? And remember, PMI prices reflect wholesale or PPI level charges, right? Price pressures. This usually will eventually get passed on to consumers. So while we've not seen these costs being passed on to consumers just yet, it might be just a question of 1 or 2 months before these higher prices at the manufacturing and services level, right from the wholesale level, eventually get passed on to the consumers. Now, on this chart here, it shows us, which starts from 2003 all the way to the present, shows us uh, the level of CPI, the level of annualized CPI, which is the line in blue, versus the ISM prices, and the average of the ISM prices. Remember here, we have the ISM prices for the manufacturing sector and services sector displayed separately. However, on this chart below, we have the average of these two prices for each particular month. And what we can observe is ISM prices typically tend to lead uh, annualized CPI readings as well. So what that means is, remember, ISM prices is what wholesalers are paying in the manufacturing and services sectors, and typically these costs that are borne by the wholesalers, whether you're manufacturing or services, eventually get passed on to the consumers, and hence that is why we will see ISM, the average of ISM prices accelerating sharply before CPI starts to play catch up. And conversely, when ISM prices peak and start to fall or start to moderate significantly lower, within a few months, we can see CPI start to follow in the same direction as well. So typically, the average of ISM prices typically have a lead time of about 2 to 3 months, uh, as compared to the changes in CPI as well. So you can see here very clearly, as early as 2020, we saw the average ISM prices start to accelerate sharply, right, rising to as high as 90%, 90%. And then within 3 to 4 months, we saw headline CPI start to accelerate, rising from about 1.5%, surging past the Fed's target of 2%, to rise as high as 9% back in middle of 2021. So you can see here typically, right, as ISM prices accelerate, right, it is a leading indicator. It tends to have about 2 to 3 or 3 to 4 months lead ahead of the consumer price index. And we can see very clearly between 2020 and now, right, we've seen ISM prices average accelerate way ahead of CPI, which is where, and this serves as a leading indicator. And conversely, and at the same time, as ISM prices sort of stagnated between around 80% and then started to moderate significantly lower, we can see after a few months, right, few months later, CPI, annualized CPI, also started to moderate significantly lower as well. However, over the last 2 months, right, due to the tariff related impacts, right, we've seen the average of ISM prices start to accelerate once more. But for now, right, the price pressures borne by manufacturers and service providers have yet to be passed on to the consumers, but perhaps maybe in the next reading, which is for the reading of June and July, we could see all these additional costs borne by producers and services, or manufacturers and service producers, be eventually passed on to consumers. And if demand continues to remain strong, right, we could see a temporary uptick in CPI as well. So we could see annualized CPI start to accelerate, perhaps in June and July, right, especially if demand remains relatively strong. So while on one hand, we have seen cost pressures or price pressures for the wholesalers, be it manufacturers or service providers, increase sharply, but this may not be reflected in consumer CPI, especially if demand continues to remain weak. However, if demand remains relatively strong, we can definitely expect those additional costs to be passed on to consumers, and that would mean potentially we would see headline CPI accelerate marginally in June and perhaps July as well. Now, will inflation pressures ease in the second half of this year? Let's take a look at what are some of the signs, right? While tariffs are expected to boost inflation in the near term, right? This is what we are expecting in June and July, right? Especially when ISM prices starts to accelerate, right? When ISM prices start to accelerate, we can typically expect consumer inflation to pick up as well. So in the near term, right, we could see CPI or consumer inflation accelerate, particularly for the months of June and July. However, several factors suggest inflationary pressures are likely to dissipate in the second half of 2025. But of course, all this, the outlook continues to remain uncertain. Now, what are some of the disinflationary offsets, right? We have seen services inflation, particularly shelter, which accounts for almost 33% of the CPI basket, This component has been cooling, with annual shelter inflation at 4.2% year over year in February, the lowest level since December 21. Now, continued disinflation in services could offset tariff-driven goods price increases. Now, demand is equally as an is an equally important part of the component, or part of the equally important component of the equation, right? Rising prices from tariffs may suppress consumer spending, leading companies to limit price hikes to maintain demand. That is why I say, right, although we have seen wholesalers start to face higher prices for the cost of raw materials, for the cost of prices paid for services, this may not be passed on entirely to consumers. So we might see consumer inflation accelerate marginally higher in June and July, but we may not see a very sharp increase, right? Particularly because, right, rising prices from tariffs could lead to suppressed consumer spending, and that would in turn may cause many companies to limit price hikes as well as to maintain a certain level of demand. Now, the Conference Board, which is a US agency, has noted that reduced spending could cap inflation in the second half of 2025, while economic growth is projected to slow as well. Now, energy prices have contributed significantly to downward price pressures, right? With gasoline down 12% year over year in May, helping keep headline inflation low, right? Increased oil production by OPEC Plus and US policies to boost domestic energy could continue to exert downward pressure, though tariffs on Canadian oil pose risk in some regions, and at the same time, what we've seen over the last 1 week or so, we've seen geopolitical tensions escalate in the Middle East, and that has caused oil prices to surge recently as well. So if we continue to see crude oil prices and natural gas prices remain elevated, right, this is going to have an impact on consumer on CPI readings as well. So although energy prices have contributed significantly over the last 6 months or so in keeping headline inflation low, right? This recent escalation of geopolitical conflict, or this recent escalation of conflicts in the Middle East has caused oil prices to surge, and it could also cause natural gas prices to increase as well, and that could undo some of the good work that was done over the last 6 months. Now, coming over and looking at Fed policy and labor market, right? The next FOMC meeting begins today, 17th of June, and is going to conclude on Wednesday, 18th of June. And the Fed, once again, is expected to maintain rates at 4.25 to 4.5% once more. Remember, after making three consecutive rate cuts at the end of 2024, right, the Fed has paused at the first three or four meetings of this year, right? Primarily due to the re-acceleration in inflationary pressures, right? As inflationary pressures accelerated in the fourth quarter of last year and remained sticky in the first quarter of this year, the Fed adopted a wait and see approach and preferred to and opted to hold rates at current levels instead of continuing with a rate hike. And especially after Liberation Day on 2nd of April, with global trade uncertainties increasing rapidly, the Fed is now even more patient and would like to see how the tariff situations evolve, how global trade negotiations between the US and its major trading partners evolve as well before making its next move as well. For now, they're adopting a wait and see approach. They prefer to be patient and are very likely and are almost all but certain to maintain the Fed fund rates on hold at 4.25 to 4.5% by the end of tomorrow's meeting as well. Right now, the labor market remains in a delicate position, right? Somewhat delicate position, and continued softening in the labor market with potential layoffs due to tariffs could limit wage growth and services inflation as well. So this is another factor that could contribute to inflationary pressures dissipating in the second half of this year. Now, should we see inflation remaining somewhat contained while economic growth weakens noticeably, right? We could potentially have four rate cuts in the second half of this year, right? So we could have four quarter point rate cuts. Should we see inflation remaining contained, and especially if economic growth start to weaken significantly. Remember, in June and July, we could see a slight uptick in consumer inflation because of the higher prices being charged uh, by by manufacturers and service providers, right? And that could have some pass-through effect onto consumers. So we may see some marginal uptick in headline CPI and core CPI in June and July. However, as we progress into the third quarter and fourth quarter of 2025, we could see all those price pressures start to unwind as economic growth in the US starts to slow down, and especially if the labor market continues uh, to highlight significant weakness as well. Now, what are the temporary tariff effects, right? Many economists suggest tariff-driven inflation may peak in the third quarter or even as late as the fourth quarter of this year, right? But trend back downward by 2026, 2027, right? As businesses adjust supply chains and foreign producers absorb some costs. Now, the 90-day tariff pause and ongoing US China trade negotiations, US European Union trade negotiations could further mitigate impacts if de-escalation continues. Of course, uncertainties remain, right? The risks remain, including potential tariff escalation. Right? Remember, although there's a 90-day tariff pause, if the ongoing negotiations don't bear any meaningful fruit, right, we could potentially see a re-escalation of tariffs, of levies being of tariffs being levied. We could see disruptions for supply chains, or potentially we could see stronger than expected consumer front loading as well, right? As tariff concerns may accelerate, right? We could see consumers and businesses start to front load their purchases as well. Now, if businesses pass costs more aggressively onto consumers or if demand remains resilient, inflation could stay elevated for even longer. Right, so the Fed's focus on labor market risk and inflation persistence adds uncertainty to the timing of rate cuts as well. Now, to conclude, right, since the first quarter of 2025, US consumer inflation has cooled from 2.8% to 2.4% year over year by May, with core CPI remaining unchanged at 2.8% for the last 3 months. Right, this was driven primarily by disinflation in services and energy. However, as I mentioned, right, we've seen energy prices surge over the last few days, right, over the last week, especially primarily due to the ongoing conflict in the Middle East. And if we see sustained uh, increases or sustained elevation in energy prices, this is going to have a huge impact on consumer prices for the month of June and July. Remember, as I mentioned, ISM services prices and ISM manufacturing prices have increased sharply over the last couple of months, and all that costs borne by wholesalers, right, would eventually be passed on to consumers as well. And combine that with higher energy prices, we could potentially have or we could potentially have a re-acceleration of consumer inflation for the months of June and July. Now, trade tariffs and policy uncertainties have had limited impact so far, right, with many businesses absorbing costs or delaying price hikes. However, nascent price pressures are emerging, right, as seen in the ISM prices indices, and inflation is expected to rise to 3 to 4% in this. It could rise to 3 to 4% in early second half of this year. Now, signs of dissipation include services disinflation, weak demand, and low energy prices. Although now low energy prices may not be a sure thing, right? And potential Fed rate cuts, but risks like tariff escalation or persistent uncertainty could prolong price pressures. And finally, the Fed's cautious stance and ongoing trade negotiations will be critical in shaping the inflation outlook as well. Remember, the US and China continue to hold trade negotiations. US and the European Union as well. Nothing has been formally signed off just yet. There's a rough framework in place. However, a lot of the details in this trade framework between the respective partners have yet to be ironed out. So there's still a lot of uncertainty in play. A lot of trade negotiations are still very fluid. The situation still remains very fluid, and things could change as abruptly as what we saw in April as well. Now, let's move on over to the charts and trading view and take a look at how the dollar index has traded over the past few months. Remember, April was Liberation Day. That's when the tariffs were released. But even before that, we saw the US dollar come under pressure as well. Remember, as early as February and March, President Trump had already levied tariffs on steel and aluminum imports into the US, and that had already started to increase or raise uncertainty. And following Liberation Day, that's when we saw everything fall apart. So we can see investors and traders alike losing confidence in the value of the US dollar, and that has caused the dollar index to drop as much as 11.1% by 21st of April. And then even as recently as last Friday, the dollar index was down as much as 11.4%. So you can see the US dollar has fallen out of favor for both investors and traders, and that has caused the dollar index to lose more than 11% since middle of January. Right, so you can see very clear uh, downward momentum for this index, right? And we can see that it continues to trade underneath the red Ichimoku cloud, which highlights the ongoing bearish momentum. We can also clearly see a series of lower highs and lower lows, and even from as recently as middle of May, we can see the dollar index continues to trade within this downward channel here. And you can see all many technical factors, right? Uh, Highlighting the ongoing downward trajectory, highlighting the ongoing bearish momentum as well. And the dollar index is trading very close to what I see is a significant support level now. Right, if I zoom out and look at the chart for the dollar index back in March of 2022, we can see that the dollar index actually formed a triple bottom here, a triple bottom in March of 2022. So very clearly, very strong support level for the dollar index at around 97.90. So quite clearly, we can identify the first support, which is a multi-swing low at 97.80. Right, and this is where the dollar index managed to stabilize last Thursday and Friday. So you can see very clearly the level at 97.81 is a very significant multi-swing low support, which we have labeled as the first support here. If this level gives way, where's the next potential support? For that, we have to come back to the charts on March of 2022. And the next major support could be this pullback level here, right? It's a nice pullback level at around 97.25. We can see a swing high resistance being formed in January of 2022. We see a little bit of resistance here at the end of February in 2022 as well. But this level at 97.25 looks to be a pretty decent pullback, which we can identify as the second support. Right, in terms of resistances, right, there's a pretty noticeable gap here on the chart for the dollar index between Wednesday and Thursday, 12th of June, 11th and 12th of June. Right, this gap here could serve as an intermediate resistance level as well. Right, this could serve as, or rather, I would say this would serve as the first resistance, and this level sits at 98.60. Higher up, we can also see the dollar index remaining under 98.40 in the first week of June as well. So this is where would spot the second, or this is where I would highlight the second resistance at 99.42. Now, on this downtrend that begins from 12th of May, we can also run a Fibonacci retracement, beginning from, of course, the swing high on 12th of May, going down to the lowest point, which is on Thursday, 12th of June. Looking at all the fibs, we can see that 23.6% retracement aligns very well with the first resistance, and 38.2% also aligns close enough to the second. So we'll keep 23 and 38% retracements in our analysis, and it adds these retracement levels provide further significance to the strength of this resistance levels here. Right, so you can see here, right, very clearly dollar index continues to trade within this downward channel. Not only do we have an immediate resistance at 98.60, which is accompanied by Fibonacci retracement at 23.6%, the upper trend line of the downward channel itself can be an area of resistance as well. Right, and beyond that, we have another resistance level at 99.42, which is also accompanied by Fibonacci retracement at 38.2%. right? So these are the key levels here for the dollar index on the daily time frame, key support and resistance levels, and with ongoing trade negotiations and ongoing uh, loss of confidence for the US dollar and US assets, right? We've seen, and particularly US Treasury bonds as well, we've seen both of these asset classes depreciate very significantly in 2025, right? And while all this has been going on, right, we can see gold prices continue to remain elevated, right? Remember, gold, uh, while a falling dollar or falling dollar index, right, can also support gold prices, right? Of course, remember, as gold is priced in the US dollar, falling US uh, falling value of the US dollar typically pushes up gold prices, and combine that with heightened geopolitical tensions, combine that with potential acceleration in inflation, right? We continue to see this precious metal remain strongly bidded. Remember, in times of safe haven, in times of political crisis, geopolitical crisis, demand for safe haven assets such as the yen, such as the Swiss franc, and of course the precious metal gold continue to see strong bids, and that has helped, of course, to keep gold prices elevated. Remember, falling value of the US dollar, heightened geopolitical tensions, potential risk of inflation accelerating have kept this precious metal strongly in its upward trajectory. Now, we can see that since 6th of May, gold prices have failed to climb above $3,432, $30 per ounce convincingly, although it did try to break above this level last Friday and on Monday, and we can still see that it continues to remain restricted, generally underneath the $3,430 per ounce. So quite clearly, this is where we would identify the first resistance. Now, we can also see that the intraday all-time high for spot gold was formed on 22nd of April, and this level is at 3,500. And this is where we can label the second resistance. Now, in terms of support, I see gold prices hovering at what I would label as an intermediate support level. This is a pullback level at $3,384. Right, I'm going to be labeling this as the intermediate support because this is not a very strong level here, support level. So if this level does give way, we can expect gold prices to pull back deeper, and where it could finally find strong support is at this level here at 3,284. We can see gold prices managing to stay above this level very easily or quite noticeably since 22nd of May. The first support is this pullback level here at 3,284, and second support is an overlap at 3,132. We can see previously this level functioning as a strong swing high resistance back in early April, and then after breaking higher in mid-April, we saw gold prices pull back sharply by mid-May, bouncing off the pullback support at 3,132. As it bounces off this level, it creates a very significant overlap, which we can label as the second support. Now, on this uptrend here, okay, before that, I would also like to highlight this ascending trend line, right? We have a pretty significant ascending trend line. So the combination of the intermediate support at $3,381 and the ascending trend line have helped us identify a strong support zone. However, if this area gives way, we're likely to see a much deeper pullback in gold prices, and where it could finally stabilize is at around $3,284, which is where the first support sits. Now, on this uptrend that begins from 15th of May, we can run a Fibonacci retracement ending with the high on Monday. And when we look at all the fibs, we can see that 50% retracement aligns very well with the first support. And we can also see that 23.6% aligning very well with the intermediate support. So we keep these two levels on, right? So take note, currently gold prices are hovering around the intermediate support, which is accompanied by Fibonacci retracement at 23.6%. However, this ascending trend line continues to remain respected. As long as this ascending trend line remains intact, we could see gold prices continuing to grind a little bit higher. However, if this ascending trend line gives way, remember we can expect gold prices to pull back much more deeper before stabilizing at around $3,300, where the first major support sits. Now on this uptrend, that begins from this swing low here on 7th of April, going up to the intraday all-time high. And when I look at all the fibs here, we can see that the 61.8% retracement also helps us identify a strong support zone alongside the second support, right? So we can see here, the second support is not only an overlap level, but it's more of a zone as well. And finally, one last retracement that will be running is from the swing low here of November 2024 going up to the intraday all-time high. When I look at the 38.2% retracement, I can see that this retracement aligns very well with the second support. So not only is the second support a significant overlap level, it is also accompanied by not one but two Fibonacci levels, basically the 38.2 and 61.8% Fibonacci retracements. And when you have two retracement or when you have two Fibonacci levels around a particular price zone, we can label it as a Fibonacci confluence. And typically, Fibonacci confluence areas tend to function as very strong resistance, or in this case, very strong support zones. Right, and finally, let's take a look at oil prices. Right, as I mentioned, oil prices were dropping significantly lower since middle of January, with oil prices losing as much as 31%. Right, WTI oil losing as much as 31% by the second week of April. Right, however, we've seen prices rebound strongly since the second week of May. Right, rising or rallying as well over 35%. Right, so very strong rally in oil prices, and if we see sustained uh, uh, increases in the crude oil prices as well as natural gas prices. This is all eventually going to be reflected in producer prices as well, right? Transportation companies, manufacturing companies, industrial output is all impacted by higher energy prices, which eventually is going to get passed on to consumers as well, right? So higher energy prices could undo a lot of the good work that was done in the first half of this year. Right? So while we've seen oil prices rally sharply, right, we can see it seems to be constrained. WTI oil continues to be constrained underneath $74 per barrel, right? And where I can see a nice resistance, one of the first resistance barrier is around $75.90, right? The first major resistance looks to be around this level. And when I run a Fibonacci retracement from this swing high on 15th of Jan, going down to the swing low on 9th of April, right, I can also see the 78.6% retracement, right, is a level where crude prices look to have stalled earlier this week as well, or rather have stalled last Friday, right, close to the 78.6% Fibonacci retracement. Right, so in fact, I would say $75.90 would be my second resistance, and first resistance is this level here. Right, there's a nice sort of like a pullback resistance level at $74.20, which is also accompanied by Fibonacci retracement at Fibonacci retracement at 78.6%. This is where the first resistance has been identified for WTI oil. Now, this prior level here was a potential support area at $70.90, but this level has given way, right? Remember, as price broke above a prior swing high resistance, right? This was swing high resistance formed in the first week of April, and as crude prices broke above this level last Friday, a prior swing high resistance could function as a potential pullback level, but that has not been the case. We can see Monday's pullback dropping well below $71, and although prices look to have stabilized around this level now is no longer the first support, right? Where the first major support could be is at this level here, almost like a nice overlap at $16.46. And we can see WTI oil stabilizing at $68.50 at the end of December 2024, at the end of February 2025, running the resistance in mid-March, and then finding support once more to the end of March. And of course, finding support yesterday, Monday, 16th of June. So this level at $68.46 is a pretty decent overlap, which we can label as the first support. Slightly below, right, I can spot another pullback support level at $65.50. Previously, this was a very significant multi-swing low, with the first significant swing low being formed in September of last year, and the second significant swing low being formed on March of this year, right? So what was previously a very strong multi-swing low support could function as resistance as it breaks lower, as prices broke lower in early April. However, as prices climbed back above this prior resistance, this is now likely to function as support as well. So that's how we've labeled, that's how we've identified the second support. It is a pullback level at $65.50. Now, on this uptrend that begins from 30th of May, we can run a Fibonacci retracement up to last Friday's high. Looking at all the fibs, we can see that the 38 and 61% retracements align pretty well with the first and second supports respectively. Right. So although we've seen oil prices pull back quite sharply since last Friday and particularly last Monday, right, WTI oil continues to remain elevated, right, trading at around $71.30 per barrel, right. It could make another strong attempt to rise up towards the first resistance, especially if we continue to see on the conflict in the Middle East continue to remain elevated, or even worse, if it continues to escalate even further, posing a risk to uh, oil supplies coming out of that region, particularly through the Strait of Hormuz. So the Strait of Hormuz is a very important sea passage where many companies, oil vessels are uh, sh- uh, sh- shipping out crude oil via the Middle East to the rest of the world as well. It's a very important and critical sea passage in terms of with all with respect to uh, global crude oil supply chains. All right, so that's all I've got for you guys today, right? Once again, thanks for tuning in into today's session brought to you by Vantage. Right, although we've seen inflationary pressures moderate in the first quarter of this year, however, we've seen price pressures start to increase, particularly from the perspective of manufacturers, manufacturing and service providers, wholesalers, and all those additional costs could eventually be passed on to consumers as well. Especially if demand remains relatively strong, we're likely to see price pressures or price pass-throughs continues to take effect. However, if demand remains weak or continues to get even weaker, those price pressures may not be passed on to the consumers. All right, that's all I've got for today. Right, thanks everyone for tuning in to today's session. Do look out for all upcoming webinars brought to you by Vantage, and I wish you all the best in your trading journey. And I look forward to seeing all of you at the next session. All right, thanks everyone. Take care and have a great trading week.